Hello everyone, this is Christian Madarasz. I'm the instructor of the OAD 162 program with North Island College, and this is a video overview of Chapter 8. So in Chapter 6 and 7 you were dealing with the special journals, and I had a short video there just going through the posting process. In Chapter 8 we're completing the accounting cycle for a merchandising company. So if you recall earlier on, we talked about the two types of companies. There's like a service company and there's a merchandising company. So a service company sells services. For example, I have my own accounting business, so I invoice people for the time that I spend or the job that I do. I don't sell them a product, I sell them my service, I sell them my time. So I have revenues and then I have expenses, the cost of advertising, the cost of utilities, rent, things like that. For a merchandising company, they sell customers things. So an example of a merchandising company would be a bicycle shop. The bicycle shop would sell people bicycles. So when they sell something, there's an inherent cost of that product going out the door. When we're completing the accounting cycle of a merchandising company, we have to do a couple different things. And one of the things is that we need to go through and figure out adjustments for things like inventory. So sometimes inventory gets damaged or stolen or returned, things like that. And we're also going to talk about things like unearned rent, supplies that are used, the insurance that's expired, depreciation expenses, as well as salaries that have been accrued. So when we're adjusting for inventory in a merchandise system, now a merchandising system usually will use a perpetual inventory system. The perpetual, there's two types of inventory systems. One's called the perpetual. So that would be something like Walmart would use, where when you go through and there's a barcode and they scan it, that goes into their point of sale system. And that, once you scan something at a Walmart till, their inventory number automatically goes down. So it'll show inside their internal books that a piece of inventory has gone out the door. At the end of the year, they have to do an inventory count, because the inventory balance may not be correct because of things like theft or damage or a mislabeling. So they adjust at the end of the year from this perpetual system. They do a physical count of the inventory, and then they make an adjustment to the inventory levels to account for these things that could happen: the loss, the theft, the breakage, errors in recording. And sometimes this is called shrinkage or loss due to theft, things like that, but we'll just call it shrinkage for now. So when we're going through this perpetual system, you need to really think about what's happening to the accounts. So let's say that I had 100 bikes and I sold 3 bikes. So my books show that I have 97 bikes left. But when I go to the warehouse and I count them, I only count 96 bikes. That means that I have one too many bikes in my books, or I've got one too few bikes in my shop. But the books are the things that need to be adjusted. So if I have counted 96 bikes, but I had 97 in the books, then think about the transaction. I have to reduce my inventory by the cost of 1 bike. So we go through this and we say, okay, what's happening? Sometimes things will get run through incorrectly, and there might have been 98 bikes for some reason. Somebody didn't take a bike even though they paid for it. So we look at the transactions and we analyze what's happening with the transactions. If the inventory count is lower than what we show in our records, then we credit the inventory. So we show the inventory level's gone down. We put that to what it should actually be, and the debit goes to the cost of goods sold account or section. If the count is higher, then we do the opposite. We record the inventory up to where it should be, and then we credit the cost of goods sold. Another sort of adjustment that happens is for an item called unearned revenue. So this is common. In this case, they have it down as rent, but a more practical example for us on Vancouver Island, for example, is in the construction industry. So in my practice, in my accounting practice, we have a company that deals with preparing kitchen cabinetry and things like that. And before they even start the work, they'll sign an agreement with their customer, and the customer will give them a deposit. Now, sometimes this deposit is just given to them even though they won't start the work for 2, 3, 4 months. So we need to account for those deposits because they're not earned revenues. Revenue is earned once the service has been provided or once the merchandise has been sold. When someone gives you a deposit, that's an unearned revenue. Unearned revenue is a liability account. So liability accounts and revenue accounts work the same as far as debits and credits go. A credit increases the value of a liability. A credit increases the value of a revenue. So it works the same, but this unearned revenue account sits on the balance sheet. So in this example, it says on December 1st, Arts Clothing received $600 for 3 months rent paid in advance. So Arts Clothing is probably sub-renting some space. So they got $600, but the company that's renting from them hasn't used the rent yet. So this is unearned rent. And then each month, we would record 1 month's rent from unearned rent and recognize it as revenue. So if this is 3 months, that means that each month is worth $200. So to record the adjustment for the unearned rent, at the end of the first month, we say, well, we're going to debit unearned rent and then say we earned $200 in rental income for December. So when I look at my balance, it started off as $600. At the end of the month, I said, well, $200 of this was actually earned. It shows up as rental income, leaving a balance of $400 of unearned revenue. Similar, there could be janitorial services that happen. So in the unearned janitorial services, example, this is exercise E8-2A, that we say that these janitorial services have occurred. So what happens is we say, okay, $400 has been recognized as revenue, so we take it out of the unearned balance, put it into earned revenues, and that's the balance left over in unearned is $200, which shows that they're still, even though they've received the cash for it, they still owe $200 worth of services for that. Now, all of these adjustments happen in a worksheet, and the worksheet process is it's not a formal document, so it's not like a formal report like the balance sheet or income statement. The worksheet is something that accountants and bookkeepers will often use just to sort their thoughts out in a manual bookkeeping system. So for this following example, we're going to use the problem 8-1A, and this problem is on page 400 of your textbook. So this is the worksheet for Jim's Hardware of Halifax, and in this worksheet it shows the opening trial balance. Sorry, this is the trial balance. So after all the regular transactions have been posted, it shows these various accounts that have gone through. And the worksheet has two different sections. So this first section is the adjustment section. When you start doing the work, there'll be a second section to the right of this adjusted trial balance that'll be a balance sheet and income statement section. And this is used to help formulate the way you're going to complete the balance sheet and trial balance. But for now, we're just dealing with the adjustments area. So there's several different adjustments. There's 4 of them. The first adjustment says that the physical count of inventory, when they counted up the inventory, it was valued at $615. So the first adjustment says that this ending value should be $615. There's only $600. So the transaction that needs to occur is that we have to do a debit to this transaction for $15. Second transaction says that the insurance expired is $150. So if I look at my insurance, I had $684. If insurance expires, it means that this asset is decreasing by $150. So I'll be crediting that for $150. Depreciation expense, that's a way that we allocate some of the way the assets are being used up. It says it was used up $60. And then there's accrued wages. So if I go forward to what these adjustments would look like, adjustment A, physical count of the inventory is $615. So I debit my merchandise inventory by $15, and then debits equal credits. So in this perpetual inventory system, my credit goes to the cost of goods sold account. For the second transaction, it says I've used or expired $150 in insurance. So I credit my insurance, and on the debit side, I say that this is insurance expense. If I had insurance expense listed, I would put it there, but I don't, so I add the account. For the depreciation expense, it says that I've incurred a depreciation expense on store equipment of $60. So you have to now analyze the transaction. If I'm incurring an expense, that expense, when they increase or debits, so I'm going to debit depreciation expense. I'm going to credit this account called accumulated depreciation for equipment. We don't credit the equipment account, we credit this accumulated depreciation. This is a contra asset, remember. Lastly, we've accrued wages. So accrued wages means that somebody's worked for a couple days, but they haven't been paid yet, but we owe it to them. So we say that there's $90 of wages payable, so it's a liability account, and we say there's $90 owing for expenses. So even though it hasn't been paid yet, we still incur the expense. We then take these figures, so this is $600, we add the debit to give us $615. $684 debit, adjust for the credit, leaves us a balance of $534 debit. We carry that over. The $660 credit, adjust for $60 additional credit is $720. So we go through this process of transferring the values over. Prior to doing this, actually, we go through and we add up all the debits and all the credits to make sure they balance. That way we make sure that debits equal credits in the adjustments. Then we go through, do the adjustments, add it up again, debits equal credits. Always double check this stuff. It'll save you a lot of grief later on. Once we get these figures, then we go to the next stage, which is transferring these trial balance figures over to the balance sheet side and the income statement side. So most of the time, these trial balance accounts will be listed in the order of assets, liabilities, equities, revenues, and expenses. Down where we did these new adjustments, these won't be in order, so this is where you have to be a little bit cognizant of where this account has to go. We take the asset accounts and we record them where they belong. We take the equity and liability accounts and record them. When we get into the sales, now we start putting them into the income statement side. Sales return is a contra revenue account. Sales discounts is a contra revenue. Then we have different expenses that go through. Everything looks good. Wages payable. Payable, that's a key word. That means it's a liability. So that's going to show up on the liability side. Once again, we add up the columns and debits and credits. Now in this case, the debits and credits will not balance. And that's because there's either an income or a loss showing in these accounts. So there's different ways to memorize whether this is going to be an income or a loss for this figure. The simple way is to look at the income statement, the revenue side. There's $11,000 of revenue. Look at all of the expenses. There's $8,751 of expenses. So using common sense, what should this number be? Well, common sense says that they made money, so this must be net income, rather than saying it's a loss. So that's the down and dirty nuts and bolts of doing up a worksheet. After we prepare the worksheet, these figures would then be used to prepare the financial statements, which is the next part of this exercise, preparing financial statements for a merchandising company. So the purpose of these financial statements is that companies want to know how much money they made in the gross sales. It's also important to know what sort of discounts did they give and what's being returned, because this could be a very important number for the company. If they're making lots of sales, but then within a week or 2 weeks, people are returning because of deficiencies or because they find a better deal somewhere, knowing what these returns and allowances are is actually a really important number. So we start with the gross sales. So you think if I sold $1,000 and somebody brings something back, well, that's a contra revenue account, so that would come off. Maybe I gave people discounts, that would come off the gross sales. This leaves me the net sales figure. From the net sales, I take off the cost of goods sold, and that gives, it's not listed on here, but that gives a figure that we call the gross profit. So the gross profit is the net sales less the cost of goods sold, and that will give you the gross profit. So that's like big profit. That's before all the other expenses. The gross profit is the big profit. Gross profit is the big profit. It's before all the other expenses come off. It's just the sales, less what people gave back, and less the sales discounts they gave to people, less whatever it cost me to sell them the stuff. So the cost of all the bikes that I sold, take my sales, less the cost of the bikes, that gives me my big profit, my gross profit. After the gross profit, we have the operating expenses, and they can sometimes be broken down into two spots. There can be the selling expenses. So these are expenses directly related to selling items. And then there's the administrative expenses. These are the expenses that are incurred whether you sell something or not. Now, in this example, it's actually kind of interesting. We could have a whole debate on whether some of these expenses are actually selling expenses or administrative expenses. For example, the insurance expense. Well, that's going to happen whether they sell one bike or whether they sell 1,000 bikes. This insurance expense, in my opinion, should be an administrative expense. The depreciation of office equipment, that could be part of the selling. The store equipment, I imagine, is from selling the items, so they have store equipment to ring those items through. So there's all sorts of ways, but this is an example of how they could be broken up. The thing with organizing your expenses is that the management organizes the chart of accounts and the way they show up on the financial statements based on the information that they want to show. So if the management decides that the insurance expense is based on them selling stuff, then what that means is that it goes into the selling. It doesn't matter whether I agree or disagree. I could give them my feedback on it, but if they say, you know what, we want it to show up as selling expenses, that's where I would put it. These expense items, the reason that we sort of put them into these broader categories sometimes is so that we can have a better idea of what overhead costs are. So the overhead costs are costs that are incurred regardless of how much is sold. Selling expenses are often also known as variable expenses. So the more that I sell, the more that I may have to pay for sales people. The more that I sell, the more that I may have to pay for delivery. The more that I sell, the more that I may be paying for advertising expense. So that's why we have this. After all these expenses, so remember that we started off with our gross revenues, less our net, our returns and everything else. That gave us our net sales, less our cost of goods sold. That gives us our gross profit, our big profit. Then we have all these other operating expenses that come through. That will give us our operating income. Then we'll have this other section. So sometimes there's other sources of revenues or other expenses that come through. Other sources of revenues could be maybe they're subletting a little bit of rental space. So this is an other income item that may be best shown on the bottom of the financial statement. Just like there could be other expenses. Perhaps there's interest being borrowed in this example. They borrowed money and we want to show the interest as a separate line item at the bottom of the income statement for money that's been borrowed. So in a very, very broad, like upper level sense, we have the net sales. Remember, that's the gross sales minus the sales returns minus the discounts. Gives us the net sales less the cost of goods sold equals the gross profit. Then we take off the operating expenses. That leaves us with the operating income or the net income from operations. We'll add up other income, we'll deduct other expenses, and that leaves us with net income. So now if you open up your text to page 406 to problem 8-3B, and on this problem they're showing a partial worksheet, and from this you're going to prepare the formal statement of income. So in this example, they don't show in these slides, they don't have what the question actually looks like, or maybe they do. Sure. Yeah, this is what we have. So on this worksheet, it shows here's the sales figures, here's some sales returns, here's some sales discounts, here's the cost of goods sold. So this is the partial worksheet part. This is what we saw in the worksheet in that income statement column. Now, how do we organize this into what we'll have as a more formal looking income statement? So the first thing we're going to do is start to look at where the breakdown of these different things. We have this revenue portion, the sales portion. So the sales is going to consist of sales less the sales returns and sales discounts. And remember, that will leave us with the net sales. We're going to have the cost of goods sold. The cost of goods sold will be deducted from the net sales. That will leave us with the gross profit. After the gross profit, we start going through and listing the operating expenses. So taking a second to say, well, which of these expenses will be in the operating expense section? In this example, we're not breaking it down between sales expense and administrative expenses. We're just going to call them all operating expenses. And for the purposes of this course, we won't necessarily be breaking down stuff into administrative or other expenses like that. We're just going to call them operating expenses just to make it a little bit easier. So we have the operating expenses. Then we also have rental income. So this rental income is going to go in the other income section. Now, when we start to compile this information into a formal income statement, it begins to look like this. And notice how we try to organize the columns so that the main information shows up on the rightmost column. When we have little sub-accounts that are affecting things, we indent one column over. So we don't want to just have a bunch of numbers coming down. It tends to junk things up. As an accountant, when I glance at this, I may just be concerned at the gross sales and then how much was returned and discounted. I may not need to know the breakdown. It's nice to have it there. But to say, well, when it comes down to the nuts and bolts of it, what were the net sales? They were $3,700. Okay, perfect. What was the gross profit? It was $1,900. Perfect. I don't need to have all the detail and the cost of goods sold over here that could be there. As far as the operating expenses, we list those down as well and then say, okay, here's the total operating expenses. The gross profit less the total operating expenses leaves net income from operations. We have this other income, so we're going to add this back in. That leaves us the net income for the year. So moving on, after we do the income statement, the next statement that we're going to prepare is the statement of owner's equity. So we always start preparing the income statement, the statement of income and expenses. Then we go into the statement of owner's equity because we need that net income figure to complete this statement of owner's equity. The next example that they show is on the same page, page 406, and it's problem 8-4B. So going into question 8-4B, we're going to prepare a classified balance sheet from the trial balance that's shown. So in this trial balance, it says that there's different balance sheet accounts. Listing this again is from the worksheet. So these are the figures that came after the adjustments happened. And we're going to work through this. And the first thing we're going to do is prepare the statement of owner's equity. And the next is we're going to prepare the classified balance sheet. So remember that the statement of owner's equity, we start with the beginning capital. We account for the net income or loss for the year. And then we take off any withdrawals to leave the ending capital number. So in this example, on page 406, problem 8-4B, it shows us that the opening capital, so we look on the income statement, I'll just take a step back here. Sorry, on the balance sheet, our opening capital number is $10,500. That's the opening capital. The withdrawals are $4,000. This is where we get these figures. From the worksheet, we know that the net loss was $2,856. So we record the opening balance from the worksheet. We record the net loss. So we're going to be taking off the net loss. We record the withdrawals. We're taking off the withdrawals as well. This gives us a decrease in capital. This leaves us the ending balance in the capital account for the end of the year. This is the number that goes onto the balance sheet. A common mistake when students are going through this process is they try to jump ahead and they use all of these figures to do up the balance sheet, and then they go, well, wait a second, my capital account's off. My balance sheet's not balanced. That's because they haven't taken the step of doing the statement of owner's equity first. So we start with the income statement. Next, we do the statement of owner's equity. Lastly, we get into preparing the balance sheet. So the balance sheet, when we're looking at a classified balance sheet, there's two types of assets. There's the current assets. So the current assets are assets that'll be, they're liquid. Now there's a lot of stuff in this chapter, and as I'm going through this presentation, I'm thinking, wow, like there's actually a ton of stuff in here. There's the current assets. There's property, plant, and equipment. These are longer term assets. They're not nearly as liquid. There's current liabilities. These are liabilities that'll be paid within 1 year. And then there's long-term liabilities. These are the liabilities that may or may not be paid off in 1 year's time. So going back to this question, P8-4B, in this worksheet that they show, we look at these assets and we say, well, which of these assets are current assets? And in this example, cash and petty cash, they're very liquid. They're worth what they have right on the spot. Accounts receivable, if I collect it, I'll be collecting this within a year, so these are current assets. Inventory, I buy and sell this stuff all the time, that's a current asset. The supplies will be used up within a year, and the prepaid insurance will be used up within a year. These are all of my current assets. The store equipment, this is going to last me a number of years. This counts as property, plant, and equipment. Just like my automobile is going to last me many years. Well, maybe not for $2,500, but if it's a $2,500 automobile, maybe it won't last me years and years. But in this case, it'll last me more than 1 year, so we call it plant and equipment. For my accounts payable, I'm assuming that I'll be intending to pay off these payables in 1 year's time. The taxes payable, we'd like to have our taxes paid in a year. And this unearned rent is money that will be earned in the next annual period, presuming that the $11,000 represents something that will be earned over the year. Mortgages are generally longer term, and the capital and withdrawals accounts are the equity accounts, and they fall under this long-term liabilities part. The accrued salaries payable, however, is also a long-term liability. So when I'm preparing the balance sheet, a classified balance sheet, I list the items. I say, here's my assets. I list them in the current assets first. I then subtotal my current assets. Notice how I'm using the columns again. So I start off here. I say, well, here's all my current stuff. Here's my long-term assets. Now, the long-term assets have some other sort of subtotals here, some sub-accounts. So I have my store equipment for my capital, my property, plant, and equipment. I call it a long-term asset. It's the same term, basically. I take off my accumulated depreciation. That gives me this number, which is my net book value. My automobile less the accumulated depreciation for my auto gives me the net book value. So my total capital assets, or my total property, plant, and equipment, ends up being $19,250. So just notice the format of this, where I've gone and I say, well, I've got to figure out this subtotal first, then I've got to figure out this subtotal to get this total. It cleans up the entire presentation of the balance sheet. It makes things look a little bit neater. On the liability side, I don't have any other subtotals to do for these accounts. I do have a subtotal for all the current liabilities, so I add them up. I've only got one long-term liability. And then from my statement of owner's equity, I've figured out what my ending capital figure is. And that gives me the ending balance sheet figure. I'm just going to have a quick look. We can see that my total assets, the $28,294, equals my total liabilities and equities of $28,294. So as we now go through this whole process, we've gone through the worksheet, we've prepared the financial statements, everything's balanced, everything looks great, we're done. Except we're not done. And this is something that occurs quite often. We've gone through this process. However, we haven't actually recorded any of these adjusting entries from the worksheet, and we haven't posted them, and we haven't done any what are called closing entries. The closing entries are what close off the books for the period. So if we go back once again to problem 8-1A, and that's on page 400, we have these various adjustments that came through the books. So this is the end of the process. I've gone through, figured out the adjustments. I've actually drafted the financial statements. So now I have to get my books up to where they need to be. So I go and I look at these adjusting entries in the columns. I have them annotated with letters. This will help you organize when it comes time to recording these entries into the general journal. And we go through and record the entries as they show. So I say the first entry is going to be a debit to merchandise inventory, credit to cost of goods sold. Then I'll add a description just describing that this is the adjustment for merchandise inventory at the end of the year. The second entry is to recognize the insurance that's expired. $150 is expired. I debit insurance expense. It's always best to show the debit side first. I credit prepaid insurance. The third adjustment was recording depreciation expense. So adjustment C, $60, and I record the $60. And the fourth adjustment was the wage accrual. So I say $90 wage expense, $90 wage payable. Please note that there's no posting reference because I haven't posted anything yet. I'm just journalizing the transaction. Now, once I've journalized everything, I would go through the process and post it. Now I have a video, I have a different video I'm posting for the special journals, but the process is kind of the same. We journalize and then we post and record the posting reference numbers there. So you would post all of the all of the adjusting entries to the general ledger account. The last step is going through and recording the closing entries. The closing entry closes off all the temporary accounts. So the temporary accounts are all of the accounts basically from the sales account down. Let's just go back here because I got jumped way ahead. So in closing the accounts, the first step we're going to do is close the temporary accounts. We're going to close the sales accounts. And we close this account, the revenue accounts, the sales account, to a new account type that we're calling income summary. It's a temporary account. It just is set up so that we have a spot to post these to. So the balance shows that there's a credit balance. We're going to do a debit entry to the income summary account. We're going to do a credit entry to the sales account. And this is actually not a great example that they're showing here. They're trying to show that this is the offset part. It wouldn't actually show up on the worksheet. The transaction that we would record this on is actually within the general journal. So they're trying just to show you that we have to do the opposite for the account. It's actually a really bad slide. It's the first time I've seen this slide. So we're going to debit the sales, credit the income summary, and this closes the credit balances of the revenues. Next transaction is we go through all of these different debit balances, these different debit accounts, and we're going to close all the debit account, the temporary accounts, to the income summary. So I go through and I say, here's all the debit accounts. So if you just think about the process, I'm looking at the income statement on the income statement column, and what I'm doing is taking all the revenue side first, all the credit side, and doing a debit entry. Then I'm taking all the debit side and I'm doing credit entries for it. And as I do these credit entries, I'm putting the balance into this income summary account. So when I look at the balance of this income summary account, it shows that my balance is $2,289, which, if you recall from that exercise, that was the net income for that exercise. So that's the balance that's left in the income summary. I've just sort of closed the account, so now I have this balance showing. I transfer that income to the capital account, and then I take whatever withdrawals there were for the year, and I take them, I credit the withdrawal account because it's normally a debit account, and I debit the capital account. Now in this example there weren't any, but if there were, that would be the transaction. Once I've gone through this process, I'm going to take the time to post those entries to the general ledger accounts, and then I'm going to review each of my general ledger account balances and record them into a trial balance. This is what we call the post-closing trial balance. So if I've done all my posting correctly, my balance sheet, my assets, my liabilities, and my equity accounts will all have balances in the general ledger. But as I go through the income and the expense accounts, those balances should all be zero. There shouldn't be anything there. So only the permanent accounts, those are the balance sheet accounts, will have non-zero balances. The last part of this chapter deals with reversing entries, and I'm just going to quickly whip through this section because it's an optional bookkeeping technique. But sometimes what they'll do is they'll have certain entries that they'll record on the last day as an adjustment. So maybe the wage payable adjustment, the wages accrued, for example. They'll record that adjustment at the end of the year to say, at the end of the year, this is how much wages were accrued. And then on the first day of the new accounting period, they'll reverse that entry. So they'll take it out of wages payable and they'll credit the wage expense account for that period, because eventually that adjustment is going to happen anyways. It just makes it easier so that it doesn't get missed later on. So when you're going through the text, just have a basic idea of the reversing entries. We won't really be using them in the course, but they are there. And as always, you can go into the My Lab Accounting section if you've purchased that option. If you've got the e-text, it comes with the actual hard copy of the textbook. And look at some of the examples that are there. And also, as always, if you have any questions, ask them in the discussion group. This gives your peers an opportunity to shine their light and show off their genius and answer the questions. And often if you're asking questions on the weekend, it's before I have a chance to get to it. So you can get the answers answered before I even show back up to work on Monday. So sorry that this is such a long video. I know that these videos are sometimes difficult to watch over a long period of time, but hopefully this helps you with this process, this adjusting and closing entries process, because it is one of the hurdles that students encounter in this course. Take care and talk to you soon.